same city, same income, same $150,000 per year. One of them pays over $40,000 in taxes, and the other, thousands less. Same income. So what changed? It's not a loophole. It's not cheating. And it's not corruption. Structure. Once you see this, you won't unsee it. Look at it carefully. Person A has a tax bill of over $40,000. Person B's bill is significantly lower. If your first reaction is, that doesn't seem fair, good, that reaction means you're paying attention. Most people believe taxes are purely about income level. They assume the higher your income, the higher your tax bill automatically and proportionally. But that's only partially true. Taxes are not calculated on income alone. They're calculated on taxable income, and taxable income is shaped by structure. That distinction changes everything. There are three primary types of income: earned income, business income, and investment income. And here's what most people are never taught in school. The tax code does not treat these equally. Earned income, your paycheck, is typically taxed at ordinary income rates. That includes federal income tax, potentially state income tax, and payroll taxes. It's straightforward. You work. You get paid. Taxes are withheld before the money even hits your account. You don't control the sequence. Business income is different. Investment income is different again. You don't just pay taxes based on how much money comes in. You pay based on how that money is categorized. Classification determines treatment. Treatment determines outcome. And outcome determines how much you actually keep. Let's simplify it. An employee's financial flow looks like this. Income tax expenses. Who earn $150,000. Taxes are taken out. Then you pay your rent or mortgage, groceries, insurance, and everything else with what remains. I'll look at a business structure. Income expenses tax. The business generates revenue. The business pays legitimate operating expenses. Then taxes are calculated on what's left. Aim income. Different order. And order changes outcomes. This is where most people miss the point. It's not about working harder. It's about understanding sequence. Imagine a business earns $150,000 in revenue. Now legitimate expenses begin stacking up. A home office deduction for a portion of rent or mortgage. Software subscriptions required to operate. Travel for conferences or client meetings. Vehicle mileage for business use. Marketing costs. Professional services. And health insurance premiums if self-employed. These aren't loopholes. They're ordinary and necessary expenses allowed under tax law. Imagine those expenses total $40,000. Instead of being taxed on $150,000, the business owner is taxed on $110,000. At $40,000 didn't vanish. It was used to operate and grow the business, but it reduced taxable income. Same revenue, different taxable amount. That's not magic. That's math, and math compounds over time. Now let's go deeper. Salary is taxed at ordinary income rates. Depending on your bracket, that might be 22%, 24%, 32%, or even 37%. But long-term capital gains are often taxed at 15% or 20%. Why would the system tax investments at a lower rate than earned income? Because the tax code is designed to incentivize certain behaviors. When people invest, they allocate capital to businesses. When businesses receive capital, they expand. When they expand, they hire. When they hire, jobs are created. When jobs are created, the economy grows. A tax system encourages behaviors that stimulate economic activity. You don't have to agree with that design, but understanding it changes how you move within it. Act to our two individuals. Both earn. On $150,000, the employee has minimal deductions. Beyond standard retirement contributions, they're taxed on nearly the full amount. The business owner has $40,000 in legitimate expenses and is taxed on $110,000. Both fall into a 24% federal bracket. That $40,000 difference could mean, roughly, $9,600 less In federal taxes alone, add potential state tax differences, and the gap widens. That's not insignificant. Over 10 years, that difference could approach $100,000 before accounting for investment growth on the savings. That's the quiet power of structure. But this isn't about saying everyone should immediately start a business. It's about understanding options. Structure is a tool, and tools can be learned. Employees still have tools available. Pre-tax 401k contributions reduce taxable income. Health savings accounts offer triple tax advantages in certain situations. Dependent care accounts, education, credits, and strategic investing can all shift how income is taxed over time. A real divide isn't business owner versus employee. It's awareness versus ignorance. Once you understand how income types are treated differently, you begin asking better questions. Instead of only asking, how do I make more money? You start asking, how will this money be taxed? And is there a more efficient way to structure this? That shift changes behavior. High earners often focus on increasing gross income. Wealth builders focus on increasing retained capital. One measures success by top-line earnings. The other measures it by what stays and compounds. The tax code doesn't reward income alone. It rewards business activity, investment, asset ownership, risk-taking, and long-term holding. When you align your financial behavior with the incentives built into the system, outcomes begin to shift. Not overnight, but steadily. And time is the true multiplier. Imagine two people earning $150,000 every year for 20 years. If one consistently retains even $8,000 too, $10,000 more annually because of smarter structuring and invests, the difference, the wealth gap, grows dramatically. Not because one worked harder, not because one cheated, but because one understood the framework and made decisions within it. Years, the deeper insight. Income is visible. Structure is invisible. Most people compete on what's visible, but long-term wealth is shaped by what's invisible. It's shaped by sequence, by classification, by understanding how dollars flow before and after taxation. It's shaped by intentional design instead of default settings. So the lesson isn't just earn more. It's structure smarter. It's recognizing that taxable income is not the same as gross income. It's thinking beyond the paycheck and into systems. The difference between high earners and wealth builders often comes down to understanding how the system works and choosing to operate within it strategically. Structure isn't reserved for insiders. It isn't hidden in a vault.